Let's hit the ground running. Yeah. So this session is for two groups: introducers, private banking, lawyers, accountants, consultants of all kind, and direct sponsors. Of course, high net wealth individuals, fund managers, founders, real estate teams, and chief financial officers. And your pains are familiar: compliance clarity, banking and custody, reporting that passes diligence, and speed to market. My goal is simple: to give you a pass you can brief your team on tomorrow. So why a fund at all? Well, because it turns one-off deals into a system. You move from ad hoc to a repeatable product, documented onboarding, segregated assets, independent NAVs, audits, and steady reported cadence. On the manager's side, you have a clear fee stack. Base management fees cover operations, and performance fees, if your teams are met, if your terms are met, cover outcomes, align outcomes. It is capital light. It scales as assets under management grows, and it is much easier for serious limited partners, LPs, to say yes to a well-run fund than to a scattered pipeline. The timing helps. Private capital is everywhere, but allocators now insist on regulated wrappers and evidenced governance. IFRS or International Limited Partners Association style reporting is a baseline. AML and KYC discipline is also a baseline. A fund gives you that package and removes friction from each raise. Here's a little bit of numbers in terms of assets under management overall in the industry worldwide. And also there is a growing number of funds from the recent years or even decades. So as you can see, separated regarding with geography. So a quick look with this quick look at the landscape, global landscape. Astana International Financial Center has a growing universe of regulated funds. Hopefully numbers speak on themselves. This time around we have like a tripled number of funds for recent years, and there is funds across private equity, hedge funds, credits, venture capital, and real estate. The direction is clear: more managers, broader strategies, cleaner infrastructure. Use the numbers on the screen as context, not a promise. Our focus today is how to do this. 3 problems work well on day one. It's in general, not only in the AIFC, but in all over the world. Project finance and credit. Fund lends against inventory and receivables through special purpose vehicle companies and asset-backed securities. Merger and acquisition programs like roll-ups or buy and build with clear JP-LP alignment and strategist draws. We can cover this in a Q&A session after Vlad will present. Real estate, the third path is real estate. You can buy, you can acquire, you can stabilize and consider listing optics where the structure allows. So there's three main reasons in the world globally for to start fund operation activities for any enterprise or high net worth individuals, for operators to set up their own shop. Instance bank. All three benefit from fund grade controls like custody, valuations, and audits. Maybe we can also do the quick prompt. If you wish, let's type your use case in chat, like credit, M&A, real estate, or other cases that we can also address during our Q&A session. So moving forward, jurisdictions and positioning. We all know the most popular fund jurisdictions before the New World Order, let's say, last few years. Jurisdiction choice is not about fashion. It's about limited partners geography, cost tolerance, service ecosystem, and the optics you need. Astana International Financial Center gives you cost efficiency, flexible vehicles, and both Kazakhstan's AIFC and DIFC ADGM have access to each other's stock exchanges. Pick what matches your investors and your budget. On this comparator, focus on 4 boxes. What is your investor base and your minimums for your investors? I mean, tickets. The second part, vehicle menu and listing options. The next one, setup and running costs, obviously. And last but not least, banking and custody pathways. You don't need every bell and whistle. You need the features your particular LPs actually ask for. Here's the tax benefits from AIFC, Astana International Financial Center, signed by Kazakhstani government. And first and foremost, it's tax deductions on capital gains. We have 0 capital gains taxes for investors via funds, investment funds, and also dividends, 0 taxes on dividends. So here's also beneficial for any LP who compares brokerage platform like ours, for instance. We provide the access to 15,000 of financial instruments globally, and investments via fund. If you buy some stocks and bonds via brokerage platform, you will obliged to pay income taxes like an individual or like an enterprise. And if you do this just buying the units of a fund, you have tax deductions. Astana International Financial Center regulation, basically AIFC regulation, is the name of regulator, allows all kinds of fund games, investment games in terms of funds, in terms of verticals, and of course in terms of structures. For instance, new markets recently obtained the waiver from regulator to increase the number of sub-funds of our umbrella fund Alga Alliance up to 2 sub-funds. Each fund has separate fees, investment strategies, etc. So it's usual. It's very popular from investors across the globe to invest through the CELS structures like PPCs, CVCs, Luxembourg, and of course umbrella funds. So the next one, given our new world order, the next one play that comes up is master fund feeder fixed structure. It's basically the model when you, if you allocate, when you raise capital somewhere in the, let's say, emerging markets to invest in Western directions like the US or UK somewhere. Both Dubai and Kazakhstan are very popular jurisdictions in this matter. So the regulation is ready. The demand is here. The demand is, I believe, also could be here, but there's just opportunity that can be started as soon as possible. Of course, if you have really diversified investment strategies like VC, private equity, hedge funds, real estate, and you don't intend to invest, do your own due diligence, invest in your own deal flow, you prefer invest through the other funds, fund of funds could be your best option. So moving forward, operations, to operations, basically any fund in the world is just front office. It's you, like a fund manager. You raise capital, you set the strategy, you make investments, you manage exits, and then the back office is your partners, like fund administrator, custodian, auditor, legal. Outsource the best back office to scale fast and safety LPs and the regulator. Your job is judgment, investment strategy, and relationships. Their job, like the back office, is NAVs, statements, reconciliations, filings, and portals. Write down the division of labor, and it prevents fire drills in the future. AIFC has 2 lines of funds. Non-exempt funds eligible for any client in AIFC with fuller oversight, and exempt funds, professional only, with lighter rules and typical higher minimums. On top of that, you can choose specialist menus, private equity, venture capital, real estate investment trust, credit, ETF, ESG, digital asset funds, umbrellas, and more. We pick the line and wrapples to match your LP profile and strategy. Here's a little bit of visualization of my previous statements. Roles must be clear. Approved individuals cover leadership and control, like a director, senior executive officer, compliance officer, finance officer. And designated functions like MLRO, internal auditor, or responsible officer may also apply. Think checks and balances and separate business from control. Think and proper ways. Here's a basic process of setting up the fund within AFSA regulation within Astana International Financial Center. It's available on the AFSA website. So it's very, very plain steps. But of course, it implicates some backs and forces regarding your particular strategy in terms of interacting with regulator. So requirements for exempt and non-exempt funds. Two pathways for the manager. Become a domestic fund manager or use recognition of your qualify if you qualify as a foreign manager. Expect illustrative capital thresholds and regulator fees. The exact figures depends on structure, custody, and scale. Plan and the budget upfront, so there are no surprises. Some teams want a full license from scratch. Others just want to launch a fund as soon as possible. New Markets offers an on-rails option under our permission where appropriate, and we coordinate the wrapper, the service stack, and day one reporting. Timeframes and costs remain subject to eligibility and regulator timelines, but the path is paved. One out of our 3 hedge funds, Algo Alliance, like I mentioned before, has 10 sub-funds. And if you're interested, we can map that in a short additional call. Moving forward to fees, documents, and investor optics. Be explicit on your fee areas. On four fee areas like placement or setup fees, first and foremost, to incentivize your sellers, your capital raisers. Then on management fees, like I said before, to cover your operations, and performance fees with hurdles and high watermarks, and redemption or early exit costs where relevant. In offered materials, show the fee table, valuation policy, leverage limits, classes and rights, gates, distribution policy, and the waterfall. Basically, we have American waterfall and European waterfall, as some of you may be aware of. If you're new in this area, you can check out my article on LinkedIn on this matter. Name your service providers and show the reporting cadence. Clarity wins trust. Here's a little bit of statistics in terms of how annual management fee averages by fund basically affects your earnings by fund type. And then the same for income impact of these fees. Regarding with investment documents, it's very simple. If you prefer LPGP, classical common structure recognized globally, you need to set up the private placement memorandum with LP agreement. If you choose the most common path for AIFC, like private investment company, you need constitution and offering materials. And regarding this time frame, here's a simple path for you to set up a fund. Big one to log the inputs, investor class, strategy, custody, reporting standard, weeks 3, 6 from the vehicle, finalize constitution and offering materials, appoint providers, weeks 6, 10, complete authorization and other accounts, authorizations and open accounts, weeks 10, 12, first close, NAV cadence, investor statements. If listing optics matter, we discuss Astana International Exchange compatibility early. So basically, it has connections with Dubai Nasdaq and Tabadul, etc. This is just for basic information. And 2 immediate actions for you. One, to download the materials and brief your team tomorrow. 2, just book a 30-minute mapping call. We will match wrapper, jurisdiction, fees, and the operating model to your LP base and asset plan. You can reach out me or Vlad or Maxim from Octagon. With that, let's move to the UAE view. Vladislav from Octagon will cover DIFC and ADGM and show how to compare apples to apples. Vladislav, over to you.
Yeah, thank you, Anatoly. Thank you for this introduction. I think you've covered a lot of valid points, and now we can move forward and discuss UAE part and also the synergy between two jurisdictions. So how can we intertwine them between each other? So first and foremost, the important question: why? Hi, hello.
Hello. Hello, Aray. Is it possible to switch off your microphone? Можно ли выключить микрофон?
Yeah, thank you.
Thank you.
So why UAE? So this new world order that Anatoly mentioned before, I think it's quite relevant to UAE as well. So the thing is, I think everyone feels it, and everyone, like, it's just in the air that that everything shifts from from Europe at least, and like people are looking for the new place to settle down and to find like a new safe haven. Let's put it this way, because Switzerland, Luxembourg, and other countries, they're not so bright as they used to, and the regulations are changing, and everyone is looking for a better opportunity and better options. So the UAE has taken over, and now looks really great for every high net worth individual in the world. And this is actually confirmed by numbers. The population in the UAE, and specifically the high net worth population, grows year by year, and the projections are like just crazy. London is going down by 33% in the near future, and Dubai is like going up by 100%. So these numbers speaks for themselves. But it's not just numbers. So the reason why people are coming here are here. So they are listed here. So this is one of the safest regions. So you can walk here on the streets safely. You don't have to worry about anything. The regulations are quite transparent. So unless many jurisdictions, UAE offers a variety of regulations. So you can either go for a English common law jurisdiction, or you can go for a Sharia law compliant jurisdiction. So a lot of things that can be actually beneficial for any person from around the globe. The political environment and scale is quite stable. The currency is linked to dollars. So if you place a deposit here in dirhams, you're basically placing a deposit in dollars, which is really great and beneficial to a lot of people. The neutral status in terms of political side of our life, of our society, and the tax regulations and flexibility, they're quite good. We still have a lot of exemptions, even though the corporate income tax has been introduced this year. For example, in terms of investments, like if you want to invest through a holding company, you can still get an exemption and pay basically a zero tax. Also, double treaties with like 130 countries across the globe, which is actually quite good. So all of these factors are really contributing to the migration of high net worth individuals to the country. And the most important part why they come in as well is the long-term strategy of the UAE to become the financial center of the world. And they are quite good at it, actually. They are catching up with all the fancy places and all the big names like Zurich, Paris, Luxembourg. So Dubai has already surpassed them based on the GFCI index, and it's been like quite a short run relatively. The IFC has been established in 2004, so Maxime and me we actually visited the 20-year anniversary of the DIFC free zone last year. It was quite an event. A lot of providers joined together to discuss everything, like to discuss, just basically talk business and catch up and have a great network. And ADGM was established in 2013. So the IFC is like basically a decade ahead of ADGM, but ADGM is catching up really quickly. So they are a bit flexible in our opinion and our experience, and they just sometimes they act quicker and they are more flexible. Let's put it this way. So a lot of numbers that you can check once you get the presentation, but you got the gist, right? So now we can move forward to discussing specifically the common law jurisdictions here in the UAE. So ADGM and DIFC. So what do they actually provide for a person or a company wishes to establish here? So of course it's a common law. So every company that was set up in ADGM or DIFC is regulated by an English law, which is basically a law that is quite familiar to each and every one and has nothing to do with Sharia law. Still 0% corporate tax on some exemption activities. Personal income tax, of course, is non-negotiable. It's always 0%. Not always, but yeah, 99% of the time. And the companies, the flow of the companies and the business that goes to those two free zones are quite significant. So you can see that the assets under management in sovereign wealth funds that are headquartered in ADGM and DIFC is basically incredible. So ADGM is bigger in terms of sovereign funds because they are in the capital. And Dubai is less in terms of, it has less assets under management of sovereign funds, but you will see that the dynamic is different in other areas. So ADGM and DIFC welcoming all of the big names in the capital markets. So BlackRock, Morgan Stanley, Wellington, all of these companies, they are either set up in DIFC or ADGM, and they have their business, some chunk of business here, and the growth in numbers is quite big. So you can see that ADGM is catching up in number of active funds and actually surpassing, not surpassing, but not surpassing the IFC. And the business that comes here is very well attracted by the factors that I've discussed before. So the dynamic is quite great, and that's the reason why we are having this call as well, because we can also help you and introduce you to the market of ADGM and DIFC, and we can help you set up your fund management company. So we can go for either ADGM or DIFC. The process is going to be pretty much the same. We will also present it here in this keynote. It's going to be in the next few slides, but just to cover the basic stuff. Own fund management company. This is the first option to set up in ADGM or DIFC. This is an independent license. It's going to help everyone manage multiple funds, and this is going to be quite flexible. So once you set up this company, you can set up many funds and manage them separately. The downside of this option is the cost and go to market. So the time to market is about 6 to 7 months, which is quite significant. But once you've done that part, you will be covered for the next decade or so. You will, of course, you'll have to comply with all the regulations, etc. But the hardest part is in the beginning. And then if you don't want to go for own fund management company, you can always go for a license sharing option, which will be provided by one of the established fund managers. So in that case, you will be joining a licensed FMC platform. And of course, it's going to provide you with the lower thresholds in all of the requirements as well as the employment requirements, and the timelines are going to be significantly less than we discussed in the own fund management. So the go-to-market is about like 3-4 weeks compared to 1 month in the option 1. And of course, there are downside to it. You will not have like the people who set up there. They won't have full control over compliance and all of the processes. Of course, they will be limited in flexibility, and they will not be affecting the growth strategy of the company as much as they would if they had their own company. So fund management company. So what they can actually do. So asset management activity falls into category 3C license in ADGM and DIFC. And this license, it allows companies place the orders on behalf of the clients, manage assets of a collective fund, but they're not. But this is very specific. You cannot deal with managing a collective investment fund. This is very separate and separated activity. And of course, portfolio management is included. Also, there is a category 4 license, which is limited to basically advisory activity, which is listed here in this list under bullets. So we can also include these activities in category 3C license, or we can opt for a category 4 license if you don't need to manage clients' money on behalf of the client. This is a table of required stuff. So which is like the most important part is that we need to have at least 2 directors, so at least 2 staff members, and they can also split the responsibilities in terms of risk officers, money laundering officers, and compliance officers. So of course we will be helping with every little step here, and not to forget that every fund management company has to get an office space in the free zone. So this is going to be like a big chunk of capex. And then we move forward to the capital requirements. So the base capital requirement is $250,000. And there is also EBCR, which is basically expenditure-based capital requirements, which is calculated based off annual operation expenses. You can also put the EBCR in the capital account, in the bank account, of course, and the capital might be invested as a deposit, for example, which is quite good because at least you will generate some revenue on that. this is the quick snapshot of the process on how to set up a fund management company. This is specifically ADGM process, but the DIFC process is pretty much the same. So first we have to get in touch with the FSRA or DFSA and start the process. We will be preparing the business plan, the financial model, then we'll go to the review, then we'll go to the approvals, then we have to get an office space, then we have to get a bank account opened and share capital deposited. And after that, we get the final approval and we can start the operations. So it seems that like it's quite significant, but that's why we actually here. We can help you and guide you through every process. And of course, you'll have my contact details and Maxime contact details, and you're very welcome to get in touch with us once you have decided to at least explore these opportunities, and we'll be guiding you through all the options that we have. What alternative fund options we have? So if you don't want to go for a full-blown fund management company, you can always opt for a standalone fund for using a third-party license. So in that case, you'll be entitled to go for a standalone fund, or you can go for umbrella or platform fund. Actually, Neo Markets has already introduced this solution, and we will be happy to introduce all of our clients to this solution. The running cost of umbrella is typically range from 0.1 to 0.5%. So this is quite fair. And of course, these terms, they may vary from platform to platform. So what options we also have? So what are the structures that can fit your needs? So of course, it can be a venture capital fund. So these funds, they focus on early stage of investments with a high risk and high reward. And they will be limited, of course, they're going to be limited to close-ended, capped at $100 million. Of course, this cap can also be removed if the regulation approves, and they will be restricted to exempt of qualified investor fund status. And yeah, so this is quite familiar to everyone, I believe. And you can also look at this from the, so what pros does it bring? It's tailored for startups, tech, and crypto projects. And of course, you will not be able to, the cons is that you will not be able to invest in any debt-related funds. For that, you have a private credit fund. So you can use that structure instead, and it will be limited to deals in terms of credit facilities. So someone who needs to borrow some companies that need to borrow money quickly. For example, we are setting up our own fund to fund the developers at the early stages when they need to build like a new project, when they have to make it. They usually need a lot of funds and credits, and they need a credit. And banks are quite tough in terms of dealing with developers at the early stages of a project. So that's where we step in, and we hope to launch this fund pretty quickly. So it can be used for private lending, real estate debt, and developer financing. And of course, the downside of this fund is that it brings the really narrow focus. So you'll be limited to limited to debt deals only. You will not be able to invest in any equity related business or mixed asset strategies. And the last fund that we wanted to discuss today is the Real Investment Trust. So REIT or REIT, whatever you want to call them. So these are funds that are focusing on the real estate management. So they invest in the real estate and also quite limited in terms of their strategy. So they will not be like offering anything debt-related deals or equity-related deals or mixed strategies as well. So it's quite stable, predictable income, transparent structure. So this is something to keep in mind. the REITs are actually public, but it also adds an additional layer of compliance. And yeah, so this is pretty much it in terms of rates. And fund registration process is a bit quicker. So once you've already set up your fund administration company, you can go for a fund registration. The process is here. So of course, we have to draft the fund policies. Then we have to go for approvals, regulator approvals. Then we have to register the fund, get the bank account opened, and start the operations. So the total timeline is 1 to 2 months, which is which can vary, of course, depends on the type of fund. But yeah, we will help you to make this process as smooth as possible. So what counterparties should we keep in mind when we deal with fund managers? So of course, legal advisors, these are probably the MVPs of every project, because they have to make sure that every action is compliant with all the regulations and suits best to the investors, and make sure that everything is safe. Auditors, they will be providing annual auditor reports, and also sometimes it requires to have like a quarterly reports. So auditors are quite a significant chunk of business that we'll need to keep in mind. Custodians, these are fund administrators. These are the providers of custody for all the assets that are going to be kept by the fund. Banking partners, these are really important as well, especially when we need to set up a fund or a fund management company, because it's going to depend on them how fast the account will be opened and how quickly the share capital will be deposited and the operations will start. So banking partner is probably, if not the most important partner here. And other specialists like compliance consultants, tax advisors, like one-off deals, etc. So they all might be required, and it's going to be dependent on the fund activities as well. And that wraps it up. So here are our contacts again on LinkedIn, so you can get in touch with us. And I believe we can start the Q&A session.
Yes, thank you, Vladislav.
Yeah, let's check.
Yeah,
let's check if we have anything in chat, right? So I'll